Hello, welcome. My name is Stephen Mantzouris, and I'm a financial advisor, licensed holistic financial advisor here in Northern California in the beautiful town of Pleasanton. And I'm talking to you today virtually because this is where the business has landed. With what's going on currently with COVID-19, as you know, we have a stay-at-home order, and I am in my home office right now. So I did want to cover some things that may be very important to you. I'm getting a lot of phone calls, and there's a lot of concern, not only their people's financial health, but their health in general. So I might want to cover a few things today that should be of interest to you. You'll have the option at the end of this webinar to watch it again if you missed something that was important to you. Also to call me or email me, and we can set up a 15-minute call and talk about anything that is concerning to you. Okay, so let's get started. This is just a little disclosure right here. I'm not making any recommendations or anything like that today. I'm just pointing some I think important information out that you should know. So we're actually all here today because, among other things that obviously have us concerned, we're nervous about the market. So I'd like to spend the next 10-15 minutes together giving you some key insights, some concrete questions you can ask yourself, and some practical action steps that you can be taking to increase your financial certainty. Because whether you're sitting in front of your TV or computer or scrolling through your phone, certainty seems to rule the day right now. Monday, March 9th, marked the beginning of the stock market crash of 2020, with the history's largest point plunge in the Dow Jones to date. That day was followed by two more huge drops on March 12th and 16th. And so far, we've seen the three worst single-day point drops in the United States history. Over the past few weeks, the markets have dropped anywhere from 25 to 30%. And the question everyone is asking is, should I stay or should I go? In other words, should I ride this thing out, as many advisors have traditionally recommended, or do I stand to lose a ton more waiting for things to bounce back? If that's you and you're wondering what to do, I want to let you know that at the conclusion of this session, you'll have the opportunity to set up a 15-minute phone call consultation or a virtual meeting with me and my firm. And I highly encourage you to do that. We've been flooded with individuals calling for advice over the past several weeks, and that's what we are here to do. We're happy to assist and access your situation, talk through your options with you, and help you get a plan in place to protect yourself no matter what happens in the market. So be sure to take advantage of the opportunity as we wrap it up today. It's really no wonder you're concerned about the market. If you ask 5 people right now what the market's going to do, you'd get 5 different answers, because the truth is no one really knows what's going to happen. And frankly, anyone telling you they can predict things should seem a little suspicious right now. We're in uncharted waters here. There's never been a global pandemic impacting the global markets as we're experiencing today. And no one can predict where things are going to go from here. So with so much information flying at you at once, how do you even make sense of it all? And knowing that no one has a crystal ball, what indicators should you be looking at right now to help you inform your decisions? Well, there actually are some key indicators and we can keep in front of us for perspective. Let's take a look at them. Here's 5 factors to keep in mind as you consider your financial future and the level of risk that you're willing to take. First, the speed at which the market has dropped. Second, the potential for the market to drop even further. Third, the skyrocketing unemployment numbers we continue to hear. Fourth, the overall impact this pandemic is having on several key industries and the overall economy. And finally, the rate at which the virus continues to spread. Let's take a look at each one of these individually. The first variable we can look at is the speed in which the markets have recently declined. It only took the S&P 500 22 trading days to fall 30% from its record high reached on February 19th, making it the fastest drop of this magnitude in history. If we look at this graph showing data from the Bank of America securities, we can see that the second, third, and fourth quickest 30% drops on Wall Street all occurred during the Great Depression era, 1934, 1931, and 1929 respectively. In other words, nothing like this has ever happened, but the closest thing to it was nearly a century ago. During the worst economic downturn in our country's history, when the market crashed in October of 1929, by July of 1932, the Dow Jones was down 89% from its previous record high. So as you think about your retirement savings, it becomes critical to consider a second factor. How much further can the markets continue to drop? Having seen a roughly 30% drop so far, and knowing we don't have the virus even remotely controlled yet, is it fair to at least acknowledge that the market could still drop considerably more? In fact, in a March 23rd article in Forbes Online, senior contributor Chuck Jones indicated that it was very plausible that the markets could drop another 20 to 40%. Again, none of us know what the market's going to do, but hypothetically speaking, if it did drop by just another 20%, bring in the total decline to 50, let's look and see what that would take for it to the market to recover. One of the things many people still misunderstand about the amount of gain required to recover from a loss, mathematically speaking, losses hurt more than gains help. I'll say it again. Mathematically speaking, losses hurt more than gains help. As an example, if you had $1 million in the market and you lost 50%, you'd be down to what? 500,000, right? So many people may think, well, if I had a 50% loss, I obviously need a 50% gain and I'll be back to where I started. Unfortunately, that's not how the math works. And this is one of the most commonly misunderstood things about the market. As you can see here, if you took 500,000 and after you had a 50% loss and you experienced a 50% gain, you'd actually only get back to 750,000, well short of where you began. Let's go back. You had $1 million in the market. You took a 50% market decline. You have 500,000 remaining. In the market, you stay in, you get a 50% market gain. You only have 750,000. It's well short of where you began. You understand? In reality, in order to recover from a 50% loss, you actually need a 100% gain. Now, how likely is that to happen in the market? Better yet, how long might that take? During the Great Depression, when the S&P 500 dropped 89%, it took the Dow Jones over 25 years to return to its previous high. So, while we don't mean to be alarmists, if you were to experience anything remotely similar, you would really have to ask yourself, do I have the time necessary to even see the markets climb back up? For someone 60 or 70 years old, they simply do not have that many years. Several of you may recognize this man. He's Warren Buffett, one of the most famous investors alive, and currently the fourth wealthiest individual in the world. Known for his market savvy, Buffett has amassed a net worth of $70.5 billion. So what does he have to say about the incurring market losses? Well, he's long been quoted as having two primary investment rules. Rule number one, never lose money. Rule number two, never forget rule number one. And why does he say that? Because as we have just seen, losses hurt more than gains help. And it takes a lot to recover from a significant loss. Buffett's always understood that if you want to make money, you start by not losing what you already have. He also recently said, it's insane to risk what you have for something that you don't need. In other words, the fourth wealthiest man on the planet isn't a big fan of taking on excess risk, particularly when it's not required for you to reach your end goal. So what does that really mean to you? It means that if you can live your life, what you desired in retirement right now without having to take on significant market risk to hopefully accumulate more, you likely should. For many who have had a good run in the market over the past decade, if staying in right now to hopefully pick up some gains if the market does recover, it would be nice, but maybe not necessary. The added risk just doesn't make much sense. So having looked at the speed of the market dropping and how much further it could potentially go, let's look at a third factor to consider. The third indicator is the alarming rate of unemployment being caused by the virtual shutdown of our nation. A record-breaking 3.3 million Americans applied for it during the week ending March 21st. The previous record in this country was just under 700,000 claims filed in a single week back in October of 1982. That means the week ending March 21st was nearly 5 times higher than the previous record. Forecasts for unemployment in April alone range from 500,000 to 5 million new Americans without jobs. In fact, weekly unemployment claim numbers are climbing so rapidly the White House has reportedly asked state officials to delay releasing precise counts. Economists at the Federal Reserve project total unemployment could reach 32.1%, totaling 47 million Americans. 47 million people. That's roughly equivalent to all the residents in New York, Florida, and Colorado combined. So unemployment doesn't look good. What about the global economy? Well, our fourth variable here is the impact this outbreak is having on major industries and the economy worldwide. The retail industry, which is normally responsible for contributing 2.6 trillion, or about 25% to the annual GDP, has nearly ground to a halt with stores closing. The hospitality industry is losing roughly $1.4 billion a week with travel restrictions now in place globally. According to Reuters, Global Airlines estimates their 2020 revenue losses at over 250 billion as planes sit idly at gates everywhere. All told, estimates suggest the coronavirus could easily cost the global economy over $2.7 trillion. What does this all really mean? Well, first, it virtually guarantees continued market volatility for months to come. Secondly, it means additional economic stimulus will likely be required by the government, which could lead to higher taxes in the future as we all have to help repay the funds that we use. But all of this could obviously be greatly improved if we just stem the tide on the coronavirus outbreak itself, right? So how are we doing there? Let's take a look. The US now has the highest number of COVID-19 cases in the world, quickly surpassing China and Italy. There are currently over 82,000 Americans suffering from it, and those numbers, by many accounts, are surely very conservative, as people in many states struggle to be even checked for it due to the shortfall in tests. The University of Washington predict that if gaps in the healthcare resources aren't filled quickly, more than 80,000 Americans could die by July. To put that in perspective, let's look at the counts in the US from recent outbreaks such as SARS or H1N1. SARS claimed 774 lives worldwide, but none in our country. H1N1 in 2009 killed 12,469 people in the US. So the death toll in just the next few months is anticipated to be 6.5 times worse. So with all these variables considered and so much feeling completely unpredictable right now, what can we predict? And what can we be sure of as it relates to your financial future? The reality is the only thing that's relatively certain right now is uncertainty. And while we'd all like to know when this pandemic will end and when everything will return to normal, the truth is we really need to be planning for the worst and hoping for the best. What does that mean tactically to you right now about your retirement savings? Well, there are obviously hundreds of things you could do with your money in this environment, but for the sake of this discussion, let's focus on 3. The first option you have with any money currently invested in the market is simply just to leave it alone. Just about everyone has heard the phrase, write it out. or have been told just to weather the storm. And for decades, many advisors have been advising their clients not to time the market, but to leave the money in for the long haul. The problem is, as we discussed, there is no current assurance that we're at the bottom of this present decline, or that we're going to see any noteworthy recovery anytime soon. And again, if the market was to drop another 20 to 40%, on top of the 30% it's already fallen, you could find yourself 60% down from where you began. Had you had an even $1 million invested for retirement on March 8th of this year, you would have just 400,000 left. Many people just aren't interested in that kind of risk. Option number 2 is to simply sell off or cash out and hang on to what you have left. For many people who have been invested over the past decade, you're still sitting on some solid gains over that stretch. And you could decide that you simply want to go to cash and completely sit out on the sidelines while this entire ordeal sorts itself out. While you'd obviously be earning nothing on your money, you might subscribe to the old saying that a bird in the hand is worth more than 2 in the bush. However, knowing that at some point in the future, hopefully sooner than later, this outbreak will end and the economy will start to recover, do you really want to miss out on all the potential gains of riding the market back up? Many people aren't interested in that either. So if staying in the market doesn't make sense, but going completely to cash and earning nothing when the market does recover has no appeal, then what are you supposed to do? Well, everyone's situation is unique and calls for custom tailored solutions. But I can tell you one benefit that many people are looking for, and that's found in option number 3. Let's take a look. A third and very powerful option for those who don't want to ride things out and don't want to just go to cash might be the use of a fixed indexed annuity, or FIA. FIAs are retirement saving vehicles that provide complete principal protection, meaning the money that you put in them can never be lost to market downturns. And they also give you the opportunity for growth. Just like a traditional fixed annuity, the FIA is an insurance product often intended for retirement income purposes. However, unlike traditional fixed annuities, a fixed indexed annuity gets its name because it's tied to the annual growth of a market index, such as NASDAQ, the S&P 500, or the Dow Jones. Rather than offering a set or fixed interest rate, an FIA's interest credit follows the performance of the market index to which it's tied. Because principal is protected in a fixed index annuity, should that market index go down in a given year, your account balance remains flat or unscathed for that year, and you simply receive no interest. 0. Should the market index rise, you get to participate in a portion of those earnings. Now, you can't have your cake and eat it too. So an FIA will not provide you with all the earnings on the upside in a rising market. Your earnings will be capped at a certain level and also be subject to spreads and early withdrawal charges. But that's the simple trade-off for knowing that your money put into an FIA will never be at risk again. It might help to understand an FIA by thinking of it like this. If you sit down at a blackjack table in a casino and the dealer says, all right, here's the deal at my table. If you lose a hand, I'll just shuffle the deck and redeal. No chips were lost. But if you win, I'm going to keep 50% of the take. If a dealer told you that, how long would you sit at that table? Who wouldn't sit there all day, right? Because you're not promised the moon. Remember, the dealer's keeping half of your earnings, your promise never to lose a dime. In other words, it's all upside possibility with no downside risk. This is very much like the premise of a FIA, a fixed index annuity. And let me tell you, right now, people with money in fixed index annuities are very happy and most likely doing cartwheels, because while their neighbors or coworkers or family members might be down 30% in the market, their account balances are simply remaining flat. They're not losing a cent. If you're wondering if an FIA might be right for you, simply ask yourself this question. Would I rather miss out? Which would I rather miss out on? Capturing every cent in an eventual market recovery when the pandemic ends, or potentially losing another 20 to 40%? If you'd be okay missing out on some of the future recovery, but you can't stand the thought of more loss, it's likely time that we hop on the phone or an email and talk about it. None of us know what lays ahead, but the chief investment officer of Guggenheim Investments just said in this recent CIO Outlook, I'm not betting on a global depression, but I am saying for the first time in this post-war era that we are really getting too close for comfort. When the CIO of a global investment company firm who manages over 270 billion says something like this, you might want to listen. The road ahead is likely to be bumpy. And while tons of things right now are out of your control, your financial future isn't necessarily one of them. That, fortunately, is something that we at the Independent Advisors can help you with. In the midst of these crazy times, it's important that you not just have a portfolio, but you actually have a plan, and we can help. Getting started is as simple as can be. While businesses all over the country may be shut down, the Independent Advisors is 100% open virtually. And a visit with us is as simple as a 15-minute phone call or a virtual meeting with me and my team. You'll just click on a link that we're going to send you at your desired time, and at that time, we can either contact you by phone or connect for a video virtual meeting using your home computer. It's that easy. Oh, and here's what that visit will not be like. It won't be a member of my team or me on the other end of the line pitching you on something or telling you to grab your checkbook. Instead, it'll be simply getting to know you and asking some key questions and listening to your present concerns. We can conduct a risk exposure analysis and show you exactly how much of your assets are currently exposed to further risk. And if you're interested, we can make recommendations as to what next steps would benefit you the most. It all starts with simply selecting a good time for us to talk and connect. I want to leave you with one more quote from our friend Warren Buffett. He's famous for having said, when it comes to the market, you never know who's swimming naked until the tide goes out. In other words, many people don't realize just how exposed they are on Wall Street until the market crashes. The good news is you can do something about any further losses starting as soon as we talk. Click on the link that we send you and you'll immediately send a confirmation email letting you know that we're all set. In the meantime, grab a cup of coffee, take a deep breath, enjoy the little things around you. It's going to be okay. And we look forward to talking to you soon. Here's the information that I was talking about. The Independent Advisors is the name of my company. TheIndependentAdvisors.com is the website. You can get to us through the website. You can call the number on your screen, 925-858-2339, or you can send us an email at Stephen with a PH at TheIndependentAdvisors.com. So it was a pleasure to talk to you today. At some point, this is going to open up and we will be able to meet. Until then, we can talk on the phone. We can talk virtually. 15 minutes. We can probably make a decision if we can do something for you and put together a plan for the future. Okay, again, thank you again. Be well. God bless. Thank you.